All right, chummed up, men. Let's do this. Welcome back to the Sleeping Tiger channel. I am the Canadian, and today I want to talk a little bit about repo markets and the overnight lending markets. Repo doesn't necessarily stand for like repossession in the sense of like, I didn't pay my bills and I lost my car, but it's more in the terms here is for the bank lending market, the internal bank lending market. So banks commonly lend to each other for overnight just to either fulfill reserve requirements, which I'll go into a little bit later. There's basically a certain amount of cash that banks have to have on hand to, I wouldn't say act as collateral, but to be a reserve for when you invest money with them. They can't go out and just invest the whole thing and have nothing to give back to you should you decide that you want to withdraw your funds. Okay, so they have a reserve requirement placed on them by the federal government. And in this overnight lending market, say banks lended their money out, that sort of thing, and they need an extra $7 billion in order to meet their reserve requirement. Well, they may go, maybe one bank says to the other bank, hey, can I borrow some money? I'll have it back to you, next day or 3 days, that sort of thing. And that bank would say, yeah, sure. And typically the interest rates on this amount of money is very low. It's about 2% or around there. And so what's happened here, and this is a website here. It's from the Federal Reserve, the Bank of New York, or the New York Feds. And basically it shows the overnight repurchasing agreement that the federal government's making with these banks all the way back to September. Or sorry, should go back further than this, but this is October 10th is the one that it's showing here, but it really started in September, around September 26th, okay? And so just to play out the whole story before I go into more detail about minutia, is that the federal government basically in September, the end of September, the overnight lending rates shot up to 7 and 10%, which is significantly higher than 2% when you're talking about billions of dollars, okay? So in order to help stabilize that overnight market, the federal government began repurchasing securities from these banks. So technically it increases their balance sheet, the Fed balance sheet, repurchasing these treasuries. I think I've seen some things where they've done mortgage-backed securities, things like that. And in order to give these banks cash flow so that they can make their reserve requirements is what they're saying. Back in the end of September, you would see that they actually said that the reason why they needed to do these repos is because there is this unforeseen tax obligation for some banks, or maybe one bank, who knows. And they needed that money. They had to pay their taxes, and they had to ask for this lending market to give them the cash flow to make their reserve requirements, okay? And there's a few things that bother me about this, because I have a feeling I know what these banks are going to try to do. So let's talk a little bit about why that's a big deal. Well, A, it means these banks are either over leveraging themselves, so they're investing too heavily, and other banks are looking at that and saying, I don't think that person's good enough to give me my money back, so I'm not going to lend. So now you're seeing a credit tightening. You're seeing other banks look at other banks thinking that they're not good for the money. So what that does is it spikes the interest rate up because, if something's more risky, they're going to want a higher return. And then the Fed had to step in to make sure that that lending market came down. Now, to quell some of the market's reaction to that, the Fed then announced that they were going to continue to do this repurchase agreement through October 10th. Well, that passed, and then they were going to extend it through November. And then they decided that they're just going to go all the way through till January, that they'd be willing to take submissions for repurchase through the federal government at 2 percentage points all the way through January, okay? And that was supposed to help with these liquidity problems, and then it was supposed to go away. But even till this day, October 24th, we still have banks requesting funds from the federal government to do a repo purchase. And so they're buying up these securities, they're giving these The feds are taking the securities, they're giving cash to these banks so that the banks can make their reserve requirements, okay? So again, this is the New York Federal Reserve. You guys can come view this. I'm going to have a link in the description so you can go ahead and follow it. But these are things that people don't talk about necessarily. I know there's a few YouTubers that I subscribe to that this is on their radar. The talking heads on TV are also, tuned into it, but they don't necessarily know what it means. They bring on all these specialists. These specialists either tell you that it's nothing to worry about, it's not QE, quantitative easing, but, if you take the labels off of it and you just look at the straight transactions, the actions that the Fed are taking, it is quantitative easing. It's expanding their balance sheet to inject liquidity into the markets. Now, the reason why they're not saying it's quantitative easing is because I guess it's more select, right? You're selectively choosing the bank that's, getting this versus using that money for the broad economy. But it's tomato, tomato. If they didn't do this, it would affect the broad economy. So yeah, it's quantitative easing, all right? So then we come here. This one is by TheBalence. It's just an article, and I found that it does a better job of explaining the reserve requirements than I could probably do in 15 minutes. So I'm just going to put a link in the description to it. There's no affiliation whatsoever. I just thought that it was very useful information, that sort of thing. But it helps really explain what's going on with the reserve requirements for banks, okay? And then lastly, before I just kind of dive into my own little soapbox of what I think is going on with this whole market and just some stuff I want to clear up and talk about, is this video here. So this video is from Marketplace APM, public media, and it does a really, really good job about explaining how the repo market works, okay? And again, no affiliation, just a really great video. I thought I'd give a shout out for it. And they do a really good job. And the one thing I really like to point out to people is look at the timestamp here. When was this? Right after the beginning of our recession, before we started rebounding. So I think it's horribly coincidental that we're talking about this now, okay? And I have my own theories about when the recession started, and I think we're technically already in a recession, and most of the times you don't know you're in a recession until it's already passed, or you've hit rock bottom, okay? So just that video there, and so I'm going to go back to this page here and then just kind of go over some of the stuff I wanted to talk about, and I'll go over my notes. So very low interest rates is usually given between the banks to other banks in the repo market. The liquidity dried up, and banks are now looking at each other as being unfavorable. What I think banks are going to try to do through this. So I have a feeling that banks are going to try to propose to the government to lower reserve requirements. Okay? So basically, they're going to say, hey, right now you guys allow me to lend money 7-to-1, and then I have to keep cash on hand. Well, can you make it so that, I can increase that to 10-to-1? So I can do more lending and, spur on the economy, get that inflation up, versus having to hold on to all this cash. Look at how much problems it's causing me. I have to come to you for money. And another thing about that is that, think about this. Let's say it was really about taxes. So you're asking a bank to pay its taxes, and then you're going to purchase treasuries from them or mortgage-backed securities or whatever asset you think you're going to pick up, or liability, and then give them cash. It's like I don't know how to describe it. It is so quasi and so screwed up that you might as well just say don't pay your taxes. If you're just gonna do this, screw it. And then, so I think that banks are gonna basically ask to have their reserve requirements brought down so that they can do more lending, and then this is gonna free up the liquidity. But really, it's just putting a Band-Aid on a wound. It's so stupid. How can we not just get our lending practices in line so that if they're making such great returns, can't we just, hey, let's start paying down some debt. Let's start letting these, investments mature, that sort of thing? Why is there this huge overextension of leveraging? Um, and so basically, there is another graph. I don't have it with me, but if you just look up, U.S. federal balance sheet, that sort of thing, you can basically see that since 2016, when President Trump and Jerome Powell was put into a position, they started quantitative tightening, which I fully supported. Um, but basically, not all the quantitative tightening, but a good majority of the quantitative tightening, the reduction in the federal balance sheet, has been wiped away in this last month. It's literally, I think, for 1 month, like 1.5 months to 1 month of quantitative tightening has been undone by just this last 2 weeks of this repo purchasing. Okay. And so it's just so painful that we can't get back to the levels of Fed balance sheets that we once had. Before we had the Great Recession, we had less than $1 trillion on the federal balance sheet. Now we're over $4 trillion. Actually, we're approaching $4 trillion at the making of this video. We were just under $4 trillion on the balance sheet. And so it's just it I love this country, and I just want it to have the healthiest economy possible so that everybody can just do well. And the reason why I bring this to your attention is because these are these, in my opinion, are leading indicators to a recession. Everybody talks about unemployment. To me, unemployment, depending on how you look at the curve, is not a leading indicator. It is a lagging indicator. Because you wouldn't say that we're in a recession till everybody's unemployed. Okay? So, you're hedging your bets if you look far enough back into the employment numbers and saying, okay, we're approaching zero. Every time we approached zero or near zero in employment, we had a recession. Then it would be a leading indicator, but you're still just kind of guessing. This, to me, seeing that banks don't want to lend to each other and the federal government has to step in and start expanding the balance sheet, and the fact that they don't want to call it quantitative easing, I don't care I don't care what lipstick you put on a pig, it's still a pig. Okay, it's quantitative easing. It's just, I really hope that people, if you're not in a good position right now, do everything you can to start saving some money, just putting cash aside. I don't think you're necessarily in a position at this point to just start chunking away at debt. If you don't have an emergency fund saved up, save up that emergency fund, get to a comfortable 3 months first, then start chunking away at your debt again, just so that you have something in case, God forbid, a layoff happens. And it can happen to anybody. It really can. So just keep that in mind. You may think your job's secured, but we're so service dependent upon everybody, from the McDonald's worker to your dentist to whoever. We really need each other. And once something starts unraveling, it slowly unravels for a lot of people, just in differing severities, okay? So I don't know how to end this on a positive note, guys. I really, really just want everybody to be very focused on play your own game, okay? Look at your own finances. Don't worry about whatever everybody else is doing, okay? You really need to think about yourself and self-preservation in the coming months and the coming years, okay? Because I'm not trying to make predictions in the sense of, hey, look at me, I was right. I would really like to be wrong. I stand to gain something from a recession, but I don't want to see people get hurt over it, especially people who are nearing retirement. If the stock market takes a dump and all they have is equities and 401ks, then they're going to probably have to postpone retirement until the stocks rally again and become something realistic. And if you're not in that boat and you have a great job and you're squirreling away cash, do it. The time is now. You have to build up that portfolio. The yield curve's been inverted for quite some time now, and recession usually precedes 6 months to 9 months after that. And so, to me, all the indicators are leading the right way. Don't listen to the people talking on the news. They're just picking at straws to find positive data to throw at you to keep this thing limping along. Because if you think about it, they're all run by different conglomerates, but mostly all like monopolies, that sort of thing. They're all going to be saying the same message, okay? All right, well, thank you very much, you guys. Thank you for tuning in to the Sleeping Tiger channel. Once again, I am the Canadian, and I'm trying to think of something positive to leave off on. Uh, we'll get through this. We always do. It's just you have to plan in the immediate time to get through the recession, and then once we come out on the other side, it'll be sunshine and rainbows, and we can all start fattening up again. Okay.